Hey, it's Joe. Next part of the video, still talking about exit strategies, except this time, when you're analyzing deals, you have to look at the exit strategy, and you should look at, are you selling this property to an investor, or are you going to sell it to an end user, someone who's going to live there, a resident? I sell to both, and I think they both make a lot of sense, but you need to structure the deal based on that. Now, an end user, it's easier to sell to somebody on terms as an end user. If you're selling to an investor, it's easier to sell an investment property if the property is cheaper and it has a good return on its investment. Now, you could sell a property for $1,000, and there's people out there that'll buy $1,000 properties, but it may cost them more money in the long run, and it may not be a good return. So what I find is you want to make it, if you're selling to an investor, you want to make it as cheap as possible for them, with as a high return on their investment, and by cheap as possible. If you can stay under $35,000 or $40,000, there's an awful lot of people out there that have that much money in their 401k that's not performing, that may be making 2 or 3% return on their investment in a money market account or in their mutual fund, or maybe, God forbid, I know this has happened to a lot of you, where you've actually lost a big chunk of your pension fund or your retirement funds. It makes a lot of sense if you can go to those folks and say, look, I can get you, 10, 12, 15, 18%. I try not to sell anything under, 14, 15% annual return, cash on cash return on investment to people. And then I also try to get them other things like depreciation, long-term appreciation, depreciation on the taxes, long-term appreciation on the value of the property, and then also buying the property under market value. I try to sell them under market value. So it makes sense on a lot of different levels to the investor. First of all, it's possible for them to do it because it's a lower price. Second, it makes a lot of sense because it's getting a high return, cash on cash return, which a lot of these folks that are buying are looking for their retirement. And if they're getting this money coming in every month, especially from something like rental property, which makes a lot of sense, because especially if it's professionally managed and you got a good manager handling it, if you can provide that turnkey package to an investor, there's going to be a lot more investors who are willing to buy that kind of property. And those are the types of properties that I sell. And those are the types of properties that I suggest that you sell. And when you analyze these deals, look at them and with that in mind, can I sell this property to an investor, and where is it going to be difficult for them? If I sell a $200,000 property, let's say it's valued at $200,000, but I'm able to get it for $100,000, I can still probably sell that property. But if I have to buy it for cash, then I've got to find somebody who's got $100,000, and those people are fewer. And there's still a lot of them out there. There's still a lot of people that can do it. But if I'm just selling a fixer-upper and they can get it for $100 and it's worth $200, if they sell it and maybe they need to put $10,000 into it, that's a good deal, and that'll make sense for a lot of people. But you still have to be an active investor to do that. And if you're an active investor and you've got $100,000 to invest, there's probably some things there's probably some places that you could put the money that would give you a better return than that type of deal, because you may be stuck with that deal after you're fixing it up and cleaning it up and then selling it, and you're going to sell it at a discount. You got to find a buyer who's going to pay top dollar for it and be able to get a loan for it, an end user. All these things create difficulties and lower the value and lower the return on your investment. So it's going to be less likely that I would turn to my investors and say, here, come buy this $100,000 property. It's worth $200,000. The other reason is because it's hard to know what the real values are on properties right now. There's some debate out there about how whether or not comps are valid at this point, because there's so many foreclosure comps out there that are skewing the market. So you need to look at the market and say, okay, what is selling for market value that's selling to a real buyer rather than to an investor, or is selling because it went into foreclosure. Those foreclosures are creating a lot of problems right now in valuing properties. I can't tell you honestly how much any of my properties are really worth right now, because the comps aren't showing the real value. If I were to sell them right now for their current comparable market value, I'd have a hard time justifying that to myself, because I know I'd be leaving money on the table. And I don't suggest that you do it either if you can hold on to the properties. But if you're just setting up the deal so that you can sell it, if you're just setting it up so that you can flip it quickly to another investor, you want to make sure that that deal makes a lot of sense. So are you selling to an investor or are you selling to an end user? I just talked about what investors are looking for. Let's talk about what end users are looking for. They need properties that are in good condition, typically, properties that they can move into now, properties that the payment on them is no higher than market rent, and that payment doesn't require good credit, and it doesn't require very much down payment. So all those things, if you can provide that, you can sell a property in just a couple of weeks. There's very few properties that we don't sell, if we sell them on a lease option, that we don't sell in 30 days. If they don't sell in 30 days and we do the marketing that I teach, then it's because, almost all the time, it's because the price that we're asking, the monthly payment that we're asking is too high. We can inflate the purchase price of the property quite a bit, 10, 15, 20%. And like I mentioned in one of the previous videos, where we'll go from 350 to 500,000 on the purchase price, and we'll still find buyers for it because it'll make sense for their situation. But we can't raise the monthly payment above market rent. If you do that, it makes it very difficult to sell. So you want to stay on track with that and try to get your profits on the back end. Or make your profit through the lease option fee, because you can usually get 1 to 10% on a lease option fee, and typically getting 3% is probably average on a lease option fee, if I were to make such a bold statement. So that's the next part of this exit strategy thing. Decide whether or not it's going to be sold to an investor or to an end user, to a resident. All right, hope that helps.